High-earning expats in Germany routinely hand over up to 42% of their income to Finanzamt, all while filthy rich real estate investors pay almost nothing. That's because the German tax system is notoriously brutal on high salaries, but is incredibly generous if you know how to use real estate as a legal tax shelter. Want an example? You can sell a property just 1 year after buying it completely tax-free. Not 10 years, 1 year. But unfortunately, when most people buy a property, they focus entirely on the purchase price and completely ignore the hidden tax benefits. That's why we are breaking down the blueprint to real estate tax optimization, giving you the exact steps to legally outsmart Finanzamt and keep your hard-earned money. To make sure you are saving as much taxes as possible, it's important to understand the entire real estate timeline step by step. So let's start with step number 1, the purchase. The moment you buy a property, you pay 3.5 up to 6.5% in transfer tax, depending on the state the property is in. Most people take that as is, but here's the secret. Finanzamt only taxes the land and the building, not what is inside. So separate movable extras in your contract. If the property contains a fitted kitchen, furniture, or maintenance reserves, list their realistic values separately in the purchase contract. This pulls that amount out of the tax calculation, legally saving you thousands of euros. Are you building a new home instead? Then buy the land first and build later. If you sign 2 separate contracts with a clear time gap, you only pay transfer tax on the plot, again saving you tens of thousands. And if you intend to rent to commercial businesses, opt into Umsatzsteuerbefreiung under paragraph 9 of the German Tax Act. Then you can claim back the full 19% VAT paid on the purchase price, the closing costs, and renovations back from Finanzamt. Pulling off this commercial VAT refund requires precision, because if you make a mistake, Finanzamt will reject your claim on the spot. So if you want to see how these tax benefits work in detail, book a free meeting with us right here or with the link in the description. Now that you own the property, you get the ultimate tax benefit in step 2, depreciation. Complicated word, but it's actually simple. The government allows you to write off the cost of your building to lower your taxable income. But if you blindly follow the standard rules, you are leaving thousands on the table. That's why trick 1 is to optimize your purchase price in the buying contract, because only the building can be written off, not the land. So instead of accepting Finanzamt's default tables, which artificially inflate land values, explicitly write a legally sound, aggressive building to land ratio into your notary contract to maximize your tax deductions. And if you want to increase your tax benefits even more, get a remaining useful life report, Restnutzungsdauergutachten in German. Standard rules say a building depreciates over 50 years. But if a certified expert proves your property only has 25 years of economic life left, your annual deduction instantly doubles. And if you invest in historical monuments, Denkmalschutz, you can write off up to 100% of your total renovation costs over just 12 years. That's for existing buildings. And if you're building new, use a massive 5% degressive depreciation. For buildings bought or built between late 2023 and 2029, you can write off a massive 5% of the remaining book value every single year, which you can even combine with section 7b Sonderafa, which gives you an extra 5% deduction for the first 4 years if the property meets energy efficiency caps. At some point, you might need to renovate your property, or you specifically bought a renovation property, because this is the biggest tax trick of all. Have you heard of the 15% rule? Anschaffungsnahe Herstellungskosten in German. No? Let me explain. If you buy a property and immediately renovate it, you can deduct all renovation costs from your taxes immediately. But if your net renovation costs within the first 3 years of buying exceed 15% of your building value, you are forced to write them off over 50 long years. So, to increase your immediate tax benefits, do the following. Time your handover strategically. If you agree with the seller to let contractors in Before the official transfer of ownership, the Nutzen-Lastenwechsel, these costs stay outside the 15% boundary. If you plan a massive project where you're improving more than 2 of the 4 core areas, plumbing, electrics, windows and heating, at the same time, Finanzamt claims you lifted the property standard, forcing you to depreciate the costs. So leave at least one area unchanged to keep your immediate tax benefits. And for any smaller construction tasks later on, use the 4,000 euro rule. Invoices for building measures that stay under 4,000 euro net are generally accepted by Finanzamt as a maintenance expense. So always ask your contractor for 2 separate invoices, one for the actual modernization and one just for maintenance. Let's talk about 2 tricks you guys ask us all the time before any of you guys goes to jail for tax fraud. Now that your property is renovated, you need a tenant. Maybe one of your family members. The government allows tax advantages if you look after your relatives, but you have to use the 66% rule. If you rent an investment property to your kids or parents, you can set the warm rent as low as 66% of the local market rate, not lower. Then, Finanzamt still allows you to claim 100% of your expenses and depreciation. If you go lower, there will be a lot of bureaucracy coming your way and you risk losing your tax benefits entirely. Are you subletting a room in your home instead? If you earn less than 520 euros a year from that, the extra income is completely tax-free and does not even need to be mentioned in your tax return. And the second thing you ask us all the time is number 5, advanced setups like an Immobilien GmbH or a family foundation. I get it. Social media is flooded with finance gurus calling corporate entities the ultimate thing. But for most investors, rushing into this is a massive mistake because corporate setups are not a holy grail. Yes, an Immobilien GmbH pays only 15% tax on rental income, while you pay up to 45% as a private person. And yes, a holding company can buy properties with a share deal to pay 0 transfer tax or sell the property at an effective tax rate of just 1.5%. And also yes, you can utilize Section 6b tax reserve to roll over corporate sale profits within 4 years into a new deal, and the family foundation is equally awesome. But here's what the gurus don't mention. Corporate structures come with heavy ongoing accounting fees, massive legal compliance, and they completely eliminate your standard private tax benefits. All this stuff is only worth if you have properties worth millions of euros. Below that, the fees will eat the benefits entirely. So the smartest play is to buy properties privately first, hold it for a decade, and then sell it tax-free to your own Immobilien GmbH or family foundation. Talking about selling, this brings us to the final number 6. The most well-known German real estate law is the 10-year rule. If you hold a rented investment property for at least a decade, every single euro of profit is 100% tax-free. And if you lived in the property yourself, you can use the 2 New Year's rule. If you lived in the property during the year of the sale and the 2 preceding years, you can sell tax-free. Did you listen closely? This means you do not need to wait 3 full years. A time span of just 1 year and 2 days is enough if you move in and out right around New Year's Eve. And if you're married, use the spousal swing, Ehegattenschaukel in German. If a property has gained massive value over the last 10 years, sell it to your spouse completely tax-free. Your partner then gets a brand new, much higher purchase price as the foundation for their depreciation, making it worth for both of you when you file your joint taxes together. But how does your spouse pay for it? With a private seller loan. Your spouse deducts interest rate at their high income tax rate of up to 45%, while you pay only the flat 25% capital gains tax on the interest you receive. If you want to know more about that, let us know in the comments and we'll make a video about it. Thanks for watching und bis zum nächsten Mal.